Hello and welcome to our Market Alert video for today, which is January 10, 2025. Didn't say 24. I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America. And thank you for watching this video. I hope it finds you healthy, wealthy, and wise. And also, make sure you go to our website. It's rpoa.com. We do a podcast. We have a radio show. We have all kinds of videos, all kinds of resources available to you to achieve your retirement goals. And so this week, I want to talk about the fact that we got some very, very strong jobs numbers, but the market dropped like a stone. Why? It's good news, right? People have jobs and the labor market seems to be holding. Why is that such bad news? So I'll explain it in just a moment, but before I do, I want to talk a little bit about the wildfires in California. And it's such a tragedy. It is so awful. I can't even begin to imagine what it must be like to, just see your home and your belongings and everything just going up in flames like that and just burning to the ground. I can't think of too many things that would be more terrible than that. We have several offices in Los Angeles that are affected by this. We have employees and many clients that have been affected by it. And so, for them, one of the most important things is to make sure you have an emergency fund, make sure you have liquidity so that if you need money quickly that you can get to it. And we're certainly making ourselves available to our clients and our employees to help out with that, should they need access to their accounts or anything like that. So our hearts, our prayers go out to everyone in California, and we hope that this will pass soon. And gosh, the devastation looks like a bomb went off. It's just horrible. So it kind of makes thinking about, inflation and interest rates and the stock market kind of unimportant. And compared to that, it is unimportant, but it is important nevertheless. And so we march on. So again, thanks for watching and thanks for being here. So the jobs numbers came in way, way better than the economists on Bloomberg survey thought they would be, almost double. And so that means we can read from that it looks like the labor market, the consumer, is holding on to their jobs. And so that's a very good thing because 70% of our economy is the consumer spending, and they need jobs to be able to do that. So that should be a very good sign, right? I mean, people are holding on to their jobs, should be good. Market dropped like a stone. Why? Why is such good news so terrible? Well, if you guys have been watching this video last year, all through the year, we were talking about what the Fed was going to do with inflation, how they were going to react to inflation, what they were going to do with interest rates. And throughout the year, we were saying that no, inflation has not come to heel. Inflation, in fact, we said would start trending back up into the end of the year and potentially early of this year. And that the Fed would not be lowering interest rates 12 times like many of the biggest banks and many people thought. And in fact, we said when the Fed did lower interest rates last year that it was a mistake in our view, because if you lower interest rates, you stimulate the economy. If you stimulate the economy, you create inflation. And so it's counterproductive in our view. So, they jumped the gun is what we said. And now it looks like that's the case. With these strong jobs numbers, it appears that the Fed probably did not need to lower interest rates. And that also inflation did not come to heel as they thought. And that being the case, inflation may start picking up again. So why did the stock market react negatively to all of that? Well, because the stock market is, as we've always said, stock prices are a function of profits. And if companies have big profits, their stock price goes up and vice versa. And cheap money, i.e. lower interest rates where they can borrow cheaply, where they have cheap money, that goes directly to making profits. If money is cheaper, companies can borrow and grow their businesses more cheaply, and that lends to more profits. So the fact that now looks like it's been taken off the table, this notion that the Fed is going to start like lowering interest rates now at a dramatic rate, that seems to have been taken off the table right now. And because of that, the people that were betting on inflation coming down, interest rates going down, profits going up because of it are taking their money off the table. So we don't view this as being the beginning of a recession or the beginning of a bear market. We think it's people who made the wrong bet are taking their profits. After all, the market has done well over the last few months, and sitting on the sidelines and waiting for potentially a better time. Same with the bond market. We've seen the bond market get clobbered, and it's because of the same thing. Many in the bond market thought interest rates would go down. That makes bond prices go up, and that's not going to happen, it looks like, for the time being, and therefore those people were wrong, and so they're selling their investments and waiting for a better day. So overall, what does this all mean to us as retirement planning investors? Well, the news was good. If consumers have their jobs, they are going to continue buying. That's what we do in this country. That will drive profits, and that will sustain the stock market in our view. So in the short run, this is, we believe, a profit-taking endeavor. It's going on right now. We could see the market go down another 6, 7, maybe even 10% from here. It's very possible. But at the same time, we don't think it's going to turn into a big, bad bear market because the news is good. And over time, that's what drives the stock market, is the consumer buying stuff and keeping profits going. Now, therefore, our outlook for this year continues to be a good one, and we continue to say that the Fed is not going to be aggressively lowering interest rates, probably not until the second half of this year. So you heard it here first. But in the meantime, as we work with people who are over 50, who are retired or retiring soon, and so because of that, we believe that you should always have a strategy to protect yourself on the downside. Big bad bear markets come out of the blue. They're almost impossible to predict. Y2K, basically, we were there, we helped protect our clients from that. And every time the market went down, it was a buying opportunity, except for when it wasn't. And then in 2008, same sort of thing. The market started going down and people said it's a buying opportunity. And no, it wasn't. And so having a strategy to address these things, because you don't know, you can't predict them, is super important in our view. And in our firm, because we do work with people who are over 50, who are retired or retiring soon, our strategy we call invest and protect. And our strategy says when it's time to be in the market and when it's time to be out of the market. And it told us to be out for all of 2008 during the credit crisis, when the market went down 57% from peak to trough. Also, the day before the pandemic was announced, our strategy said to sell, and so we did not. We were out before the big drop that came during the pandemic. And so that's what we want to do for our clients. Many of our clients want to retire or are retired. They're drawing income from their investments. And that being the case, you can't take big losses or it could change everything for you. And we don't want that. So therefore, that's why we have our strategy. So right now, I guess what I would say is this is not a moment to panic. It may turn out to be a buying opportunity here soon. But always, 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 in our view, have a strategy to protect yourself on the downside. There's got to be a place, know when to hold them and know when to fold them. Okay, so we believe in that too. Buy, hold, and sell. So thank you for watching this video. As I said, I hope it finds you healthy, wealthy, and wise. And please go to our website. It's rpoa.com and check us out. Make sure you subscribe to our podcast as well. And we'll talk soon.